Whenever a market gets too stretched above its 30-week moving average, sellers eventually overwhelm buyers, and the market has two choices to correct back to the 30-week moving average. It can either correct rapidly in price to move back down to the 30-week moving average, or it can correct through time and hold on to its gains, but eventually move back towards that moving average where it's a lower risk time to buy, because at this point sellers once again are losing control to buyers that'll push the market higher into another up leg. For example, in the gold market, after gold broke out into a new bull market in 2001, it started establishing a pattern where whenever it would get to about 10% above its 30-week moving average, it typically underwent a multi-month correction. And you can see on this chart, for example, in 2002, when gold got to about 10% above its 30-week, it eventually came down and kissed the 30-week and the 50-week moving average before resuming the uptrend higher. And it did this again in 2003 and again in early 2004. And psychologically, as people are chasing the market to these highs, they get in at the wrong time and they have to suffer through a multi-month correction typically before the up leg resumes. And when they get in close to the top, a lot of times they have to suffer through almost a year-long correction before the market starts making new highs. So really these entry points, when it looks like the bears are in control, but the moves back to that next best time to buy during a bull market, which is at the moving average, is where you want to do your buying. But it's psychologically hard to buy when we're retesting the lows here. Looking at the gold bull market from 2009 to 2012, gold experienced kind of a more accelerated bull market during these years, but again, this example holds where when gold got about 15% extended above the 30-week moving average, it went back down and touched the 30-week, but it actually didn't go back down to the 50-week during this entire uptrend from 2009. But again, when it got to around 10% or so extended above the 30-week, it once again was usually going to go down and test the 30-week after that. And it's noticeable that during these bigger spikes, it took longer to start establishing new highs again, but during these smaller spikes, when the market wasn't as stretched, it only took maybe a couple months before gold started making new highs again. So the higher you get extended above these moving averages, the longer the typical corrections before the uptrend reestablishes itself. Now, in gold's current case, gold got to about 10% extended a few times during the last few months. And I personally thought gold was going to make another higher high after it broke out of this consolidation pattern, but it's starting to look more likely that we're entering this multi-month correction in gold right now, and we're only about 5.5% above the 30-week at this point. So if we are in a correction starting from last week, it could take maybe a month or two, or maybe during the rest of the summer, for gold to finally retest the 30-week moving average before it launches again into a solid new up leg higher. But that's kind of what the market's dealing with right now. Unless we were to make another new high, then the correction would probably have to start from a higher level and could take longer into the fall before the new up leg was to start. Now, looking at the gold stocks tend to get much more extended than gold because they leverage gold, and when they are really extended, they're actually very dangerous because you can have massive losses off of these big tops in gold stocks. And sometimes it takes a long time for them to make new highs after they've made these massive kind of parabolic uptrends. So, for example, the only two other times where the Huey has been more than 40% above its 30-week moving average, which it is right now, was back in 2001 and in 2002. And notice that when this occurred in 2001, it took almost 6 or 7 months before the Huey was making new highs once again. And in this example, the Huey corrected in time when it got this far extended. It took another 6 months or so before the Huey touched the 50-week moving average, and then it launched into a new up leg higher off of that. And again, this parabolic move higher into 2002 was about 50% above the 30-week moving average. And instead of correcting through time, the Huey actually corrected through price after a few weeks and suffered a 30% crash back down to the 50-week moving average in late July. And from here it bounced higher, and actually the new up leg was launched from here. But notice how volatile this up leg was, rallying back up to the highs, then crashing again to the 50-week, then rallying again, crashing one more time, and then finally launching a new up leg higher. So during these corrective phases in gold stocks, they can be extremely volatile as well, especially when they crash through price and correct to lows. They can often have these big bounces and then another move back lower again, kind of creating a trading range before the new up leg is established. But once again, the new up leg, even though it started here, it didn't really get it into gear for 6 to 8 months from the original correction point. And so that's what you're dealing with these ultra volatile gold stocks. Now, after this latest surge higher in the gold stocks, the Huey got to about 40% above the 30-week moving average. So it's vulnerable to a multi-month consolidation or a price smash back to the 50-week moving average. And it's impossible to tell, whether either of those scenarios are going to happen, but they're scenarios that are very likely to occur over the next few months until the Huey can, get that retest and be in position to rally higher once again. So expectations for gold stock investors should be for more of a trading range environment going forward, until the gold stocks can once again get closer to the moving average and they're a better time to buy for a longer term hold. So really, if you're someone who's keen on getting into the gold stocks, you have to realize that this rapid move higher is likely to not be what's going to happen in the near future for the gold stocks. And there's going to be a lot of time to where you can position yourself into these stocks for the bull market going forward, because like I said in the first picture, the best time to buy in stage analysis, if you didn't buy at the ideal breakout point, is when the market retests the 30-week moving average and provides the low risk buy point where buyers and sellers are back in equilibrium and a new up leg can be launched.